Hey there, 𝗕𝗵𝘃𝗶𝘴 with another installment of Capital Markets Investor Relations in 2 minutes or less. This is our third installment in our videos on building and optimizing financial guidance as a public company. And today's topic is the nuance of financial guidance. And remember, guidance is really fraught with difficulty and anxiety because most public company executives either haven't been at a public company before, don't have capital markets expertise, and they get very easily tripped up around, am I breaking a rule? Am I giving too much data? Am I giving the right data? And the way you simplify this and get success is a perspective shift by realizing that guidance is simply the translation of the detail of your operational finance into the summary level of capital markets finance. And remember, the key thing to remember here is, are you in control? The company is in control of guidance. And so that means you have to have control of your processes, your people, your systems to make sure that you can actually execute on the financial expectations management you're setting. So let's get into the primary guidance problem. And this is the idea that operations finance is complex detail. It's a lot of scenarios. It's constantly changing. There's just a lot of data and detail that's hard to work through that's not public. And then secondly, capital markets is simple summary level detail because again, capital markets analysts don't have that internal knowledge that's not public. And so the question becomes, as the CFO or the public company executive, how do you zoom out from your operational finance to capital markets finance? And that's where the art of nuance really comes in. And it's this idea of simple ranges, less is more. What you're trying to create here are financial cliff notes, and you create them. You provide the level of detail that's needed to get investors to act the way you think they should based on what you know about the business. And so why is nuance really important? And it's this idea that your internal budget and forecast is constantly fluctuating, and you can't have constantly fluctuating data with public company investors. It'll cause volatility in your share price. And then secondly, it's impossible to manage every input, contingency, and scenario. Remember, once you give a scenario to an investor, the investors will seek updates ad infinitum. They're always going to ask you for an update on that scenario or that data until you say that it doesn't matter anymore. And they will be relentless. So what are the key learnings? The company controls the guidance. You provide the summary of the complex detail to investors. Number two, summaries are your friend here. You're allowed to give less detail, and you just need to make sure that the less detail you give incorporates the majority of the complexity that is not public information. And then thirdly, your budget does not equal guidance. If you give your budget as financial guidance, you will destroy your stock price. With that, thanks for watching.